Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Champion Homes, Inc. quarterly report. Champion Homes, Inc. is a leading manufacturer of factory-built housing in the United States and Canada. The company offers a diverse range of products and services that cater to various markets and customer needs. The company's product portfolio includes manufactured and modular homes, park models, recreational vehicles and cabins, accessory dwelling units, commercial structures, and modular buildings for single and multifamily markets. These products are sold under multiple brand names, including Champion Homes, Genesis Homes, Skyline Homes, Regional Homes, and others. In addition to its manufacturing business, the company also provides construction services through its Champion Construction brand. This service allows customers to have their factory-built homes installed and set up on-site. The company operates a factory direct retail business under various brand names, including Regional Homes, Titan Factory Direct, and Champion Homes Center. Furthermore, it offers transportation services to manufactured housing and other industries. Overall, Champion Homes, Inc. is a comprehensive provider of factory-built housing solutions, offering a wide range of products and services that cater to different markets and customer needs. The stock price of Champion Homes, Inc. has dropped significantly over the past year due to several factors. One major contributor was the company's weak fiscal fourth quarter 2025 results, which missed Wall Street estimates and caused a 13.5% drop in stock value. This decline continued throughout the year, with further contributing factors evident in the third quarter of fiscal year 2026. Decreased net income and adjusted EBITDA were notable issues, with net income falling by 11.7% and adjusted EBITDA decreasing by 10.2%. Additionally, gross profit margins compressed due to higher manufacturing materials costs and reduced absorption of fixed costs. The number of U.S. homes sold decreased by 2.6%, while Canadian revenue declined by 23% due to higher interest rates, economic uncertainty, and a shift in product mix. The decline in manufacturing backlog from the sequential second quarter of fiscal 2026 also contributed to the overall drop in stock price. These factors combined have resulted in a significant decrease in Champion Homes stock value over the past year, with a total drop of over -20.75% since February 2025. Champion Homes, Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Champion Homes, Inc. trades at a higher price-to-earnings ratio of 22 times, and a higher price-to-book ratio of 2.94 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 27% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the positive side, several factors contributed to revenue growth in the company's U.S. and Canadian markets. In the U.S., manufacturing housing sales saw a significant increase due to higher average selling prices per new home and growing demand for affordable housing. The expansion of manufacturing and retail footprint through facility and equipment investments also played a crucial role. In Canada, revenue growth was driven by higher sales volumes, resulting in an increase of $5.6 million, 33.3%. Favorable demographic trends and the acquisition of Eisman Homes and Regional Homes further boosted revenue growth. On the other hand, several factors led to revenue decline. The idling of a manufacturing facility in Bartow, Florida, resulted in significant costs, including plant closure expenses of $6.5 million. Higher manufacturing material costs and lower sales volumes also contributed to a decrease in gross profit by $9.4 million, 5.6%, in the U.S. market. In Canada, selling, general, and administrative expenses increased by $5.8 million, which negatively impacted revenue growth. Overall, while several factors drove revenue growth, others led to decline, highlighting the importance of strategic investments and cost management in maintaining a stable revenue stream. Net income and profit margins. A shift in performance and examination of the financial performance reveals a mixed trend for net income and profit margins. On one hand, the year-to-date, YTD, 2025 net income increased from $163,939 to $182,091, indicating an overall growth. However, this positive trend is not consistent across all quarters, as Q4 2025 saw a decrease in net income from $62,827 to $56,004. The profit margins also experienced a decline. The gross profit margin decreased from 28.1% in 2024 to 26.2% in 2025, while the operating income margin dropped from 11.3% to 9.5%. These decreases suggest that despite higher sales volumes and gross profits contributing to increased net income, higher selling, general, and administrative expenses partially offset this effect. The contrasting trends between YTD and Q4 performance highlight the need for a closer examination of the underlying factors driving these changes. While the increase in net income is encouraging, the decline in profit margins raises concerns about the company's ability to maintain profitability in the long term. The company's financial performance indicates a positive trend in its operating cash flow. The data shows that the net cash provided by operating activities has increased from $194,852 in 2024 to $251,165 in 2025. This significant increase suggests that the company is generating more cash from its core operations. Furthermore, the operating cash flow for the 9 months ended December 27, 2025, was a positive $251.2 million. This indicates that the company's business activities are producing sufficient cash to cover its expenses and investments. The positive operating cash flow is a key indicator of a company's financial health, as it suggests that the business is generating enough cash to sustain itself without relying on external financing. Overall, the data confirms that the company is indeed generating positive operating cash flow, which is a crucial aspect of its financial performance. Management is optimistic about the company's future prospects. They are focused on operational improvements to increase efficiency and profitability. The company plans to expand its operations, both domestically and internationally, by targeting strong housing markets across the U.S. and Canada. This expansion will be achieved through a combination of acquisitions, investments, and plant consolidation. The company aims to grow and diversify its revenue streams by expanding its product offerings and services. This holistic approach is expected to provide more affordable solutions for customers, further driving growth and profitability. Overall, management strategy is centered around increasing capacity utilization, expanding into new markets, and diversifying revenue streams to ensure long-term success. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. Acquisitions have been a key part of the company's growth strategy, with notable examples including Eisman Homes in May 2025 and Regional Homes in October 2023. The acquisition of Eisman Homes was repeated in the first quarter of fiscal 2026, demonstrating the company's commitment to expanding its presence in the market. On the other hand, the company has also made deliberate decisions to divest certain assets that no longer align with its business goals. This includes idling production at the Bartow, Florida manufacturing plant and the Kelowna, British Columbia manufacturing plant in the first half of fiscal 2026. Additionally, a previously idled manufacturing facility was sold during the second quarter of fiscal 2026, marking another significant divestiture. The company's financial activities have been focused on both rewarding its shareholders through dividend payments and reducing the number of outstanding shares. In terms of dividends, the company has made significant payments from equity method investments in 2024 and 2025, totaling $1,011 and $718 respectively. In addition to paying out dividends, the company has also engaged in share buybacks. Over the past 2 years, it has purchased a total of $209,999 worth of shares, with $150,000 being spent in 2025 alone. This strategic move aims to increase shareholder value by reducing the number of outstanding shares and potentially boosting earnings per share. Concerns about inventory buildup and supply chain disruption are evident in the recent data. Inventory levels have decreased significantly, with raw materials and finished goods inventories dropping from March 29, 2025 to December 27, 2025. This decrease is accompanied by a manufacturing backlog reduction of $46.6 million, 15%, over the same period. However, despite these decreases, there are still concerns about inventory buildup. Accrued product liability due to water intrusion has reached $29,812, indicating potential issues with quality control and storage. Furthermore, idled production at 2 manufacturing plants and ceased operations at another plant suggest that supply chain disruptions may be more severe than initially thought. Supply chain disruption is a pressing concern, with idled production and ceased operations at multiple plants contributing to the issue. Additionally, supply-related problems such as price fluctuations and material availability are causing further complications. The potential impact of natural disasters on the supply chain adds another layer of uncertainty, highlighting the need for contingency planning and risk mitigation strategies. That concludes the financial summary for Champion Homes, Inc. Feel free to comment below, and I will be happy to answer them when possible.